everyone, and welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're talking about option premium. So when it comes down to option premium, you might wonder how the prices are calculated, and we're going to dig into that today. So basically, option premium is the value of an option, and we're looking at the dollar value of an option. So what's really important to know is that you're going to think that options are priced very small, but really we need to multiply that number by 100. So if you see an option that's worth 50 cents, in reality it's worth $50, and that's because each option contract controls 100 theoretical shares of stock. So the pricing is based on that one individual share. So in order to determine the actual dollar value, we need to take the value that's given and multiply it by 100. But with that said, we're going to look at how premium is derived, and basically, it's intrinsic plus extrinsic value. So intrinsic value is the difference between an in-the-money option and the stock price. So this can be thought of the real value of the option. So when we're looking at a call, for example, if I've got an in-the-money call at a 95 strike and the stock price is at 100, at expiration, I'll be able to buy those shares at 95, even though the stock is trading at 100. So the difference there, that 5-point difference, is intrinsic value. So if we know how to calculate intrinsic value, we can definitely calculate extrinsic value. And extrinsic value is basically made up of time and volatility value, but we can calculate it by taking the total premium and subtracting the intrinsic value from that. So in that same example, let's say I have a call option at 95, the stock price is at 100, and there's still 15 days left until expiration. Chances are that option is not trading for exactly $5, which would be its pure intrinsic value. Let's say it's trading for $6.50. So if it's trading for $6.50 and I know that I have $5 or 5 points of intrinsic value, if I take $6.50 and subtract 5 from that, I know I've got an extrinsic value of $1.50 or $150 in real life dollar terms. So let's go to the next slide and we'll break down premium a little bit further. So as you can see in this diagram, we're going to be looking at how premium changes. So on the left side, we're going to look at what increases option premium, and on the right side, we're going to look at what decreases option premium. So the first thing that increases option premium would be how far it is in the money. So in the money, or as you can see here is notated as ITM, just refers to how much intrinsic value the option has. So the more an option goes in the money, so for calls that would be below the stock price, and for puts that would be above the stock price, the further and further that goes in the money, the more intrinsic value it'll have, and therefore the more option premium it'll have. Secondly, option premium increases when implied volatility increases. So the interesting thing about this is that implied volatility is just a reflection of the option prices. So when option prices are increasing, you're going to see implied volatility increasing as well. And lastly, another thing that increases option premium is time. So the more an option has, or the more days till expiration an option has, the more option premium it will have. So just like any other facet of life, when we look at car insurance, life insurance, the more time we have covered in those insurance policies, the more premium there's going to be. And in the option world, the more time we have, the more time we have to be correct. So we're going to have to pay a premium for that right. So if we look on the right side here, we can see what decreases option premium. So one thing that decreases option premium is the further and further it is out of the money. So on the flip side of being in the money, being out of the money means that at expiration, there's not going to be any true value. So with puts, out of the money means it's going to be below the stock price, and for calls, out of the money means it's going to be above the stock price. Because if we think about buying a call is the right to buy 100 shares at a certain strike price. So if I've got a call at 110 and my stock price is at 100 at expiration, I could just buy the shares at 100 in the market as opposed to buying them at 110, and therefore my call option at 110 is going to be worthless. Secondly, if implied volatility is decreasing, that essentially means that the option premium is decreasing as well. Because again, implied volatility is really just a reflection of the stock price or the strike prices and option prices and what's going on in that specific market. And lastly, the less time we have, or the lower days till expiration we have, the less option premium there will be. So if we're looking at like a weekly option or something that has 15 or 20 days to expiration, that same exact option that has 45 or 50 days till expiration is going to be much more valuable than our 15 to 20 days till expiration that we might have. So the lower our days till expiration is, or the closer we are to expiration, the lower our option premium will be. So let's go to the next slide and we'll break down option premium further. So there's a difference between buying and selling options and getting into and out of trades. So this is super crucial and very important to me, especially when I first started learning about options. I needed to learn this first because it can be a little confusing. So one thing that's cool about options is you can sell it even if you don't own it originally. So when we're looking at selling an option, what happens is we open the trade by receiving premium. So we're basically selling an option for someone else to have the ability to exercise if they feel like they need to. So when we sell that option, we actually receive premium. And if we look to close the trade, as you can see at the bottom, for us to close that trade, we actually have to buy that same exact option back. So we have to pay premium out to do that. So basically, for sellers along the right side here, the way we are profitable is if we sell an option for a higher price than we buy it back for. So if we sell an option up here and we buy it back for a lower amount, the difference will be our profitability. Inversely, when we're buying an option, we need to pay premium at first. So when we're buying options, we pay out the premium to open the trade. And if we want to close the trade, we have to receive premium or sell it back. So we sell that option, which in turn gives us the premium, and that's how we close out a trade. So for buyers of options, we need to buy the option at a lower price than what we sell it back for, and if we do that, the difference would be our profitability. So this has been Option Premium. Thanks so much for tuning in. Let's get to some takeaways here, and we'll wrap it all together. So with Option Premium, all we really need to know is that intrinsic and extrinsic value make up the total premium. So when premium increases, implied volatility increases. And what's really important to know is that implied volatility is just a reflection of the option prices. So when premium increases, you'll see that IV would increase. Also, extrinsic value is affected by time and volatility. So it's the one thing that's pretty much cannot be calculated unless we know the intrinsic value. We can't ever really know where implied volatility will be in the future, but we do know that time will decay and lower the option price over the lifetime of that trade. So implied volatility is really the X factor when it comes to extrinsic value. And lastly, intrinsic value is affected by the depth of being in the money. So in the money is basically having intrinsic value. So the deeper in the money an option is, or the more intrinsic value it has, it's going to increase that intrinsic value and will therefore increase the option premium. So this has been Option Premium. Thanks so much for tuning in. My name is Mike. If you've got any questions at all, shoot me an email at support or you can shoot Trader Mike. And until next time, we'll see you later. Hey everyone, thanks for watching our video.
If you liked this video, give it a thumbs up or share it with a friend.
Click below to watch more videos, subscribe to our channel, or go to our website.